We're back on Morning Mover. Shares of Carvana up more than 25% in 2025. We'll get a closer look under the hood when the company reports quarterly results after the close. Earnings per share expected to come in at 75 cents on an adjusted basis on revenue of more than $4 billion. Keep in mind, shares are 10% off February's all-time high. Time now for Options Corner. Joining us to take a deeper look at Carvana, we've got Rick Ducat, the Duke of Data himself, lead market technician here on Schwab Network. All right, Rick, talk to us about the trends that you're seeing when it comes to the chart for Carvana.
You know, Carvana sells cars, but it's more like a roller coaster. The extreme volatility since its inception has just been, tremendous. Like it's not often that you see this type of movement in a stock here. But for now, Carvana over the past year pretty handily outperforming both the consumer discretionary sector and the broader S&P 500. It's up like 122% or so. But if we were to consider the chart of Carvana, we can see that, it held up at an important point in terms of support here. We can see that there was this range between about 165 to 175, a low point that we saw back in September and in March, where price held on for the most part in terms of closing prices. So you can see that's our yearly comparison of our charts here. Our candle chart would be the one where we start to see that there's an ascending triangle type pattern forming here, or a rising wedge type pattern, not ascending triangle. But we can see then that the gap would like to be filled near 280, our red line there. And to the downside, we've got our green line, a supportive area near 230 that happens to coincide with our yellow 21-day exponential moving average there, Diane. So we've got some interesting setups here as we head into earnings.
All right, interesting setups as we head into earnings. Thanks, Rick. That's Rick Ducat, lead market technician. Now to take us through an example trade, we've got Tom White, senior options contributor. All right, Tom, I know you've used Carvana yourself and you've influenced me, at least in terms of searching the platform. You have influenced me in one other way as well about a flight. I'll circle back to you on email about that. So let's talk about Carvana and how you would approach an example trade heading into earnings.
Well, as Rick mentioned, this stock moves. It doesn't have a big share float. The option market's pricing in about a plus or minus 12.5%, 13% move post earnings, or $32 either way. So expectations are pretty high for some big movement in the stock post earnings. But we've got high implied volatility levels going into the report on this one. So I looked at a strategy with the stock up over 125% over the last year. I looked at a strategy that takes advantage of different levels of volatility in each option series in a directional bias. So in this example, I'm looking at the bearish side. So really short-term positioning on a put diagonal, where I'm going to go out to the May 16th monthly options that expire in 9 days. We're going to buy that at the money 260 strike put. That's where the stock's going to open up here, about $260 per share. So you're going to buy that at the money put in the May 16th monthly options. And then in the near term, May 9th weekly options that expire in just a couple days here, we're going to sell the 230 strike put. So a bearish $30 wide put diagonal to the downside. I'm going to pay about a $12.50 debit for that. That's going to be your risk, $1,250 per spread that you do on this type of strategy, and that's less than half the width of a $30 wide bearish put diagonal. And the reason for that is those volatility levels I mentioned. If you pay about a $12.50 debit, anything below about $2.55 is going to be potential profitability on this type of trade. So you need that move down about that one standard deviation line where it lines up at about the 230 strike on this trade. And I mentioned those volatility levels. In that May 16th monthly options where you're buying the 260 put, you're buying about 123% implied volatility levels on aggregate in that option series. And then in the near-term options, in that May 9th weekly 230 strike put you're selling about a 208% implied volatility level. So there's that vol discrepancy that lowers the entry point price and the risk on this type of trade. And you do have that opportunity to potentially roll that short option as you get closer to expiration over the next couple days. We'll see that vol crush post earnings. That'll really lower the price of that put that you sold on the 230 strike in this strategy. But remember, this is a bearish type of strategy. If you think the stock's going to go lower over the next week and a half, this takes advantage of it. If you think it's going higher, flip-flop it, do a call diagonal. It's about the strategy because of those implied volatility levels, Diane.
You did it again, a 2
Yes.
for 1. I like it. You finished that one off for the other side of that option there. That's an example trade for Carvana. Thank you, Tom.